So I challenge you guys to hit 1,000 likes on the 3 stocks to buy for July 2020 video, and you absolutely demolished it. So in today's video, I spent a lot of time researching 2 new businesses that we haven't really talked at all or much about on this channel. I took a look at their reports, their financials, and I want to share all that information with you guys here today. And I only decided to include 2 stocks for this video because there's so much info to go through, and I think you may actually be pleased with what you see with these 2 stocks. They're both very high growth companies and trading at some pretty attractive valuations right now. But guys, the question of course is, can we beat the 2,400 likes that we got on the 3 stocks to buy for July 2020 video? Not sure if we can, but let's see if we can hit 3,000 on this high growth series to show once and for all that high growth stocks are better than just your regular safe boring stocks. So just a quick note before we get into our picks, a high growth company for me is a company that does around 20% or more year over year growth with their revenues. If they're around that number, I consider them a high growth company, but that also means that they're highly volatile companies, so that's something to keep note of because these are high risk plays. So the meat alternative company here is our first stock to make this video, and I know some of you wanted me to talk about this stock recently, so here you go. Everyone's heard about this brand by now, and most of you have probably even tried their products. And they make meat alternatives to burgers, sausages, ground meat, and is really a company built on the mission to make the world a greener place. Their goal is to reduce our need for meat really in the world and to turn to more sustainable food options that are supposedly better for us as well. Beyond Meat stock is currently down 44% from its highs that it hit about a year ago or so after a very irrational run-up that it had on pure hype and FOMO. Since then, the stock has reverted back down to more reasonable value at around $130 a share or so, and according to Yahoo Finance, it has a market cap of around $8 billion. So why did Beyond Meat make the list in this video? Growth, of course. This video is all about high growth stocks, and Beyond Meat has some phenomenal numbers that I want to show you guys. They're growing at astronomical rates, and this year it's supposed to hit around 54.5% growth year over year in revenue, and next year is slated for around another 50% growth year over year. Absolutely phenomenal performance expected here, and 2021 revenue should be close to around $700 million. This means that at today's market cap around $8 billion, Beyond is trading at 11.4x premium today. Now I feel that it is a bit rich to pay a premium this high for Beyond Meat, but it is growing at over a 50% clip, and not many companies can say that they're growing this rapidly. Usually when I look at high growth stocks, I want to see a premium of around 2x or below because that shows me it's severely overlooked and severely undervalued in a lot of cases. But typically you'd find these high growth stocks in kind of like the 4 to 8x range, and that's typically the price you pay if you want to have phenomenal growth behind the business. So here with Beyond at around 11.4, it is rich. However, at a 50% year over year growth, it is higher than a lot of companies out there, so you are paying even higher of a premium for this company. So I can see arguments made either way that, even at current prices, it's still a pretty good value. Now I want to spend a couple minutes looking at their fundamentals because regardless of the growth, if a company has a poor balance sheet or they're losing a ton of money where I don't see a path to profitability, more likely than not, I will not invest in the business. So assets for this business looks very healthy at almost $250 million in cash and $415 million in current assets, making up the total assets value of nearly $500 million. By contrast, liabilities don't look so bad. Current liabilities sit at $72 million, easily covered by their current cash balance. There's no problem here. And their total liabilities, which has around $17 million or so in long-term debt, sits at just under $100 million, which is once again covered by the $500 million in total assets that they have. So in my opinion, this is a very stellar balance sheet that Beyond Meat has. Next is the income statement to see if they're actually profitable, and if not, how much cash they burn and if there's any path to profitability that I see. In the last quarter, BYND posted very good numbers. Revenue grew by 141% and cost of revenues grew by 101%. This is a good sign because it shows that they're growing revenues faster than the cost to acquire this revenue, which is a healthy sign for any business, especially high growth businesses. So instead of a loss year of $5 million from operations, which they had a year ago, they had a gain, and this all resulted in a net income that was positive for the quarter of $1.8 million. Now, this is not a whole lot of money, but it is a sign and shows us a trend of the company moving closer and closer to consistent, sustained profitability, which is a sign of a strong business. So from what I see here, I'm actually pretty pleased with Beyond Meat. They have a very, very strong balance sheet. They have extremely strong growth. Their income statement shows us that they are moving towards consistent profitability here with a small profit in the last quarter, but with the continued growth that they're showing, it should continue growing year after year. And overall, I have to say I'm pretty impressed with what I see. And guys, we haven't even talked about the partnerships that this company has right now with massive, massive giants like McDonald's. And one of its most recent partnerships is with Starbucks in China. So they're getting into some big players here with massive exposure. And over time, if these partnerships stand, it can make them a lot of money by piggybacking on the massive success from these fast food chains. But hey, that's not a bad strategy, and whatever they're doing so far seems to be working out. But now let's talk about where I'd consider opening up a position here in Beyond Meat. At under $100 per share, if they don't dilute shares anymore, it would put their market cap at around a $6.2 billion valuation, which would put the market cap to revenue ratio at around an 8.8x, which is more in line with what I typically look for a high-end, high-growth company. I know it may seem like $100 is far away from current prices, but we have been below this quite a few times in the past, and I believe that we can definitely get back down here, especially if the broader market sells off. At current prices, I still think that there's money to be made over the long term with Beyond. It's still a very tiny business, and if you believe that this company and their mission and their products are going to be used much, much more in the future, there's tons of growth ahead. So like I said, I'm happy with the prices right now with Beyond, but with my investments, I typically look for some extreme value when I start buying into a stock, especially when there's a lot of risk with the company. Now with Beyond, you're getting a good balance sheet, but there is risk in terms of volatility, in their long-term sustainability, and I factor that into my valuation to figure out where I would feel comfortable buying. So under $100, I think this could be a good addition to my portfolio. So guys, that's the first pick. I know it took a bit longer than expected, but if you're still watching, comment down below with potato to let me know that you stuck around up until this point. Cyberark is our second pick, and it's a security company with a simple mission: to provide a modern approach to identity security anchored on privilege to protect against advanced cyber threats. Essentially, with technology, there's a lot of applications that require privileges to access other applications or perform tasks and analytics and all these other things. But every time you open up these privileges to other applications, it increases your vulnerability for a possible cyber attack. Now, it doesn't matter if it's an on-premise deployment, a cloud deployment, a subscription deployment, this threat is very real and very prevalent throughout. So what Cyberark does is that they come in with their software and their platform, and they pretty much act as kind of a soldier in your network. This will provide protection to both internal and external attacks, and this company provides a ton of value here to protect valuable company data. And you can think of the world we're living in right now, right? Like everything's shifting to a more online deployment, cloud, Azure and AWS and GCP. These are all popular platforms right now for people to deploy their infrastructure on. And with that does come risks. Now, of course, these other companies have their own security, but there are other vulnerabilities in your network that hackers can get into and gather sensitive information from. So that's kind of where Cyberark fits into the whole equation. And this isn't just a problem for small companies. This is also a massive, massive problem for tech giants. As you can see here from this list, Uber, Capital One, Yahoo, these are all companies that have had breaches in the past. Cyberark, in my opinion, is truly filling a need here with security, and it isn't a niche that will only become more and more important over time as more and more businesses choose to shift everything online. So why did Cyberark make the list here for one of the stocks I'm watching in July 2020? I honestly believe that the market is really underpricing and undervaluing, just overlooking this company here because of short-term issues that they're facing, and they're not looking at what this company is going to do for the world over the long term. Cyberark has a compounded annual growth rate of 33% from 2014, which is extremely strong and shows the need for their solution in the marketplace. With recent events and with everyone shifting to work from home, more businesses than ever are shifting towards an online model and need a solution like Cyberark's. But when we look at the expected growth of 2020 and 2021, I was a bit surprised personally to see some lower numbers here for growth. 2020 is expected to grow by only 5%, and 2021 is expected to grow by around 18.7% to around $550 million. This is obviously not as great and nowhere near their previous growth compounded of 30% year over year. Now, digging into the last earnings, it seems like this is because of customers becoming more cautious with their spending, which will hurt them short term. But guys, in my opinion, I'm a long-term investor, and over the long term, I believe the story is still intact for this business. And sooner or later, customers will realize they need to protect their data. Data protection is an extremely important aspect of any business, and they will come around to realize that investing in this infrastructure now and this protection now could save them a ton of money over the long term, just in case they do face a potential cyber attack. Now, today's market cap of around $3.8 billion and annual revenue of $550 million expected by the end of 2021, it puts the premium here for CyberArk at 6.9x. This, in my opinion, is extremely reasonable for this high growth business, and if you believe that they can get back on track to around 30% growth year over year in the next few years, then this is a very attractive value today. Now, just like BYND, just like any investment of mine, I need to look at their balance sheet and income statement to make sure that what I see here with their growth and their future prospects in this regard aligns with what I'm looking for on a financial level. So their last quarter was a mixed bag. Revenues grew by 11.3%, which is well below the 30% average, and expenses were up almost 3 times as much. This all resulted in a smaller net income for the quarter and a decline of a whopping 82.5%. The question, though, you have to ask is, are all these investments that they're making right now in marketing and R&D going to pay off over the long term for the business? If your answer is yes, then this short-term decline in net income isn't much of a concern as they continue to grow their revenues. If, on the other hand, you believe the investments they're making right now are not going to pay off, then it's very likely that we're going to continue seeing lower prices in the near future. Now, in terms of their balance sheet, their assets had a steady growth this quarter with increased cash, current assets, long-term assets, and total assets. They sit with around $1.15 billion of current assets and $1.43 billion of total assets, which is very healthy. In terms of their liabilities, their current liabilities are at around $184 million, and their long-term liabilities sits at around $782 million. So although long-term liabilities is high, they still have more than enough capital available to cover their liabilities. I would say, guys, this is a good balance sheet with around 2 times as much assets as liabilities, and it is a profitable business today, so there's no concerns here for me in terms of bankruptcy or anything like that. But I will say between the two companies we talked about today, BYND and CyberArk, BYND has a better looking balance sheet to me. Now, looking at the charts here, I think that at current prices, the stock is at a very decent value. Ideally, I'd like it more in the middle of this buy zone, but I would seriously consider opening up a position at these current prices here today. This is because the company is growing, they are profitable, and they have a good balance sheet to instill confidence in their survival during these times. And like I mentioned a couple times, I do believe the shift that we're seeing in the world with businesses shifting to a more cloud and online deployment, cybersecurity is going to be taken a lot more seriously, cyber attacks are going to be a lot more common, and a company like CyberArk will be able to address these concerns. With both BYND and CyberArk, I would consider these great long-term businesses to invest in. Because of the volatility, you could see these stocks move 5 to 10% in just a few days or a week. So you can't really judge it based on its stock price, especially over a very short-term time period. But these type of companies tend to trend a lot higher over time, especially if their business continues growing. These are both very small market cap companies playing in very large spaces right now. And if you truly believe that the industry that they're playing in, meatless options and cybersecurity are going to grow over time, which I do, then these companies can both be leaders in those respective segments. So guys, if you are interested in finding out when and if I do buy into these companies or any other company, check out the link description down below to my VIP membership group. We have a whole bunch of members in there. We have a great community going, and I share every single trade that I make in there with my members. But either way, guys, thank you so much for watching. Smash that like button down below, subscribe if you're brand new here, and hit that bell notification as well so you don't miss any new videos. Hope you enjoyed this, hope you learned a ton. Let me know which of these two you would invest in, but either way, thanks for watching. Don't forget to invest positively, and I'll see you in the next one. Peace.